Okay, today I want to talk about life insurance. So you can go ahead and click out of this video right now if you want to. Most people hear that word and get a little knee-jerk reaction to it. That's totally understandable. I used to sell life insurance for a long time, so I know. My family still jokes about it. They're like, if you start selling life insurance again, we're gonna have to block your number. But no, so I want to talk about it because it is actually a good tool for wealth planning. And it's a really good tool for some of your money, not all of your money. I'm a big fan of the stock market, even though I don't really do business in the stock market per se. I am still a big proponent for it. But I also think that that having some safe money gives you the ability to be a little more aggressive with your investments, and that allows you to get higher returns typically. It allows you to be a little more disciplined as well. So I think it serves a purpose for some people. I don't think it serves a purpose for everybody. If you don't have 3 to 6 months worth of expenses saved just in a liquid savings account, you shouldn't be shoving a bunch of money into a life insurance policy. You should prioritize that emergency fund or that opportunity fund. If you're not taking advantage of an employer match on a retirement plan, I probably wouldn't be stuffing money into life insurance. If you're not maxing out a Roth IRA, I probably would be doing that first if I was young. But if you get to a point where you make maybe too much money and you don't qualify for a Roth IRA, then I think life insurance can be a compelling place to put some money. One thing I did want to address though is I put out a video, and one of the comments was, it was comparing 401ks and life insurance, and it isn't really a comparison. They're different vehicles. One's an investment vehicle for retirement. The other is more of a savings tool, an accumulation vehicle, and then really it's a wealth transfer tool primarily. So comparing the two is you're not comparing apples to apples, so I don't typically do it. But the comment was that life insurance doesn't get you market returns. And I assume by market returns, the guy was talking about the S&P 500, which is, the main index in the United States that you can kind of use as a barometer for how well the market is doing. And the S&P 500, if you put money in the S&P 500 over 30 years, you should get between 9 and 10% per year if you don't do anything dumb, which most people will. And they'll probably do something dumb a few times in their career. So life insurance is not comparable to the S&P 500 because that's not its goal. It's not trying to get you 9 or 10% a year. And I should mention this, but there are a lot of agents out there that sell, indexed universal life insurance. And what they will do is they will illustrate policies returning 9 or 10% a year, which is absurd. Like, if you ever see that, that person should be discredited right away. If you see them illustrating a rate like that to sell you a life insurance policy, run for the hills, because what they're doing is they're setting this expectation way up here, and then that contract is going to come in and perform here. And then you're going to get a bunch of people on the internet saying that life insurance sucks because I was promised 10% and I got 6%. And that's what happens. And this happens frequently. I've worked in the industry a lot. I know what people do. I know how they sell it. I know the little tricks they do to make it look more appealing than it is. So don't deal with somebody if they start showing you returns like that on a life insurance policy. It's not real, and that's not going to happen. So I think, I was listening to a video the other day, and I think they say the average return, over a lifetime, depending on how long you've had it, because the longer you have a life insurance policy, the lower the expenses are. So a life insurance policy in the early years, the way they're structured is there are a lot of expenses on the front end. And that's basically because the company is taking a portion of your money. They're dealing out commissions to the person who sold it. They're also putting money in sub-accounts and in risk management accounts because they now have this big liability on their books. So if you buy a $250,000 policy, and you're a young, healthy person, you might pay $30 a month for that, maybe cheaper than that. But if you die tomorrow, they owe $250,000 and they have promised to pay that. So what they have to do is they have to shell some of that money out and put it into, do some risk pooling so that they can pay a claim if there is one. So that's kind of part of it in the first couple of years. That's why life insurance, when you look at it, in the first couple of years, it's typically, you're not seeing much of a return on the cash value portion of it at least. You do have the insurance, which if something were to happen, you immediately have that liquid cash available for your family. So, you know, it's a good deal if you pass away early. If you're looking to use it to accumulate wealth, it's maybe not the best vehicle right away. But typically, you know, if you've had a policy for a while, you know, 15, 20, 25, 30 years, you can look back at that policy and you'll probably see somewhere between 5 and 7% a year. You can get up to that high if you've had it for a long time. It's properly structured. It's overloaded with cash as much as possible. That actually takes commission away from the agent, which is a good thing, because a lot of agents sell these policies and they don't stuff extra cash in. And what happens is the policy doesn't accumulate cash very quickly. The agent makes a big old fat payday, which great for him, not good for his client. And I've seen this happen a lot. They illustrate a policy that has tons of extra cash going in it, and then the policy they actually sell doesn't, so they end up getting paid on all that premium. It's a whole mess. So if you're ever, honestly, if you're ever talking to an agent and you just want a second opinion on what he's trying to sell you, let me know, because I worked for one of the biggest insurance companies in the world. I know their policies, I know their contracts pretty well. And then I represent a bunch of different carriers now. So, and I've dealt with a lot of different types of products. So let me know. But so life insurance is it's not geared to gain market returns. So the expectation is this is a pot of money. I'm going to put some money in. I'm not going to see a return in the first few years. Like, I'm funding this for a bigger reason, you know, and that bigger reason I think is having some tax deferred growth, having some death benefit if something were to happen, and then also having some liquidity. And that's, I think, the big value in a contract like this, is that you don't really want to be pulling money out of your 401ks when you're 45 trying to start a business, because you're going to be paying penalties, you're going to be paying taxes. But with a life insurance policy, if you built up a nest egg in there, that's all money that you can access without paying taxes. You can take loans out. You can surrender some of your death benefit. There's a lot of different ways to access that money, and none of which really include penalties or taxes. So they're a good vehicle for that. Now, the other thing, you know, as a contract, as you've had it longer, you'll hear people say, well, the cost of insurance goes up the longer you own a policy. And that can be true, which is why, you know, if you do buy a policy, you want to make sure someone knows how to build one. I've seen people who have owned universal life policies that were not structured very well, and they basically implode. But if they're designed right, that's not really a risk, because what happens is, as the insurance cost rises as you get older, because it's more expensive to insure you, what happens is that cash value approaches that death benefit. And so basically you're not paying for as much death benefit. So you're paying at a higher age each year, but you're not paying for as much death benefit. So the cost actually comes down on these policies over time if they're built right. So that's something that you want to be cognizant of. And I think of it a lot like a house, you know, like in the first few years of paying off a mortgage, almost all of your money is going to interest. You know, you're not really building any equity early on. But what happens is, slowly, as you pay off that loan, you start to accumulate a lot more equity, because you're paying that loan down quicker, and hopefully there's some appreciation on the home value as well, but you're paying that loan down a lot faster, and so you're seeing that big gap in that equity growth. So that's just something that I wanted everyone to be cognizant of in terms of life insurance. Like, it's not a market product. It's not designed to beat the S&P 500. And if you want to beat the S&P 500, a life insurance vehicle is not the way to do it, because like I said, there's insurance costs associated with it that are just, you're going to have to overcome that to try to beat the market. And it's not the vehicle to do that with. But if you're looking for a place to, have some death benefit for your family if something were to happen, you're looking to accumulate some cash, you're looking to have it in a safe place where it's not going to go backwards. And if you want some, a lot of tax advantages and some accessibility, I think life insurance can be a good vehicle for that. But yeah, that was the main point I wanted to address, was that the market return comment, because it's just not, life insurance isn't designed to beat the market. So yeah, you're not comparing apples to apples. But if you have any questions on any life insurance, if you want me to review a contract you have already, let me know. You can email me, Matt at Safe Wealth Planning. And yeah, or you can just visit my website at safewealthplanning.com, or you can find me on social media, TikTok, YouTube, Instagram, all of the places. So we'll talk to you later.